but we also have to welcome in our first corporate guest on the show today. The company in focus is CCL Products. Well, the stock has been doing rather well. It's up almost 28 to 30% in the last 1 month. And just, look at the price move yesterday, 15% just yesterday itself. But there is some concern around elevated global coffee prices. Arabica coffee prices have hit 13-year highs. To talk about this, and of course to get a sense of the company's outlook, we have with us Praveen Jaipuriar, CEO at CCL Products. Praveen, great to have you with us. Good morning. Thanks for taking this call. So let's start with the global outlook. Considering we are looking at these multi-year highs with, I think, insufficient rainfall in Brazil and perhaps a lower yield there, what is the situation right now and what is the flow through? What is the impact, if any, on your business?
The global coffee prices remain to be at very high levels. And this actually started a couple of years ago when the Brazil Arabica crop was affected due to frost and all. And while this year the Brazil crop has been good, there are reports that the Vietnamese crop could be in short supply because of El Nino effect. So these kind of supply constraints is leading to high coffee prices, and that remains right now. Only after, generally the price trends become clearer once the harvest season comes. And there are two large harvest seasons across the globe. One is the Brazilian harvest season and one is the Vietnamese. So Brazilian crop was good this year. However, that did not lead to a lot of reduction. We are expecting that the Vietnamese crop will come around November, December time. And that's the time we will get to know how the prices will pan out in the future. And really it is now anybody's guess that how will it pan out, because there's a lot of, with these kind of price increases, a lot of speculative tendencies creep in the market. So that's on the,
sorry to come in. Take your point on, we need to sort of see if the price surge sustains or not. But the fact that prices have been higher, has that had any impact on your volumes? Because I think your volume guidance is 10 to 20% for the current financial year. Do you stick to that, or is there some tendency to, put off purchases or to go for, perhaps slightly lower sizes or lower volumes?
So I'll begin with the consumption. Fortunately, even with high coffee prices, we haven't seen any consumption change with the end consumer. So people are still drinking coffee. And generally, because we are in the instant coffee segment, which is largely in-home, where the price pinch could not be as big as an out-of-home consumption could have. So we are not witnessing any consumption, pattern changes, and therefore our volume guidance remains like that. It also doesn't impact our margins because we work on a cost-plus model. The only change that we have seen is that because of the volatility, the clients or the customers, they're not willing to bet long, in the sense that they are shortening their contracts. Earlier, when the price stability was there, they would probably go for a year-long contract, 1.5 years contract. But now they are limiting themselves to a couple of months because they are also in a wait-and-watch method.
All right. Hi, Praveen. Good morning and good to see you. Yesterday, the stock price spiked up, and that's the only indicator that we have. I understand that there was some fund buying, maybe a couple of family offices as well were buying, but you'll get the bank post later this weekend, so you'll come to know on that. Basic understanding is coffee prices moving up. It's not had an impact on demand, as you're saying, so your volume guidance is intact. What is the volume guidance? We had a wide range of 10 to 20%. And I also wanted to ask you, since as you mentioned, you're a converter, your working capital cycle could get stretched, right? Because coffee prices move up. Tell us about that.
Absolutely. So, the reason why we widened our guidance was simply because of the fact that I mentioned that earlier, maybe a couple of years ago, when the prices were stable, we used to get very long-term contracts. And actually, at the start of the year, we were very clear that what will be our volume, volume growth for the year. But considering that people are a little more, in a wait and watch this thing, the clients are not very committal in terms of long-term contract. So therefore, we widened our guidance because there could be some clients who would start working on lower inventories at their end. And that was the reason we gave a little broader guidance. And sorry, the second question
on the working capital gets stretched a little bit, or it's manageable? Yeah.
No, absolutely. Working capital stretch has been there because we are growing volumes, and on top of it, the coffee prices have gone up. So it has got a double impact on our working capital. But the only good thing about our working capital is that all the working capital that, because we work on a cost plus model, all the working
Yes.
capital that is deployed is for confirmed contracts. So only if the
Okay.
contract is confirmed, we go ahead and buy coffee at the back end, which means that this working capital,
Yeah.
every penny of it is actually, sold.
Okay, so just to confirm, volume guidance you're keeping at 10 to 20%. I also wanted to ask
Right.
you about the EBITDA per kg. I think it was at around 105 odd. But since your mix is going to change towards FDC, that's likely to see some kind of a booster shot. So what is it currently? Where does it move to?
So yeah, it's currently at the similar levels as you talked about, 105 or so. And while FDC will also come in play, we also have now extended capacities of spray dried as well. So we didn't, we don't expect because one will offset the other. So we are maintaining the same guidance for EBITDA per kg for the year. Of course, we are working constantly on building more efficiencies, because at tough times you kind of build more efficiencies. But in terms of guidance, we are not, kind of changing that in the short term.
Praveen, hi, good morning. Prashant here. And I think we're speaking after a while. So good to see you here. And we're talking to you as we consume copious amounts of coffee here. So, I mean, looking at this coffee consumption in the studio, I can tell you that demand is not going to be a problem. If this is a sort of, any indicator. So in terms of top line, for 25, you did 730, sorry, beg your pardon. I think for the full year, FY25, if you can give us a sense of what the number will be on the top line front. You did 2650 crores, for last year. That is FY24. What could the number be for 25?
So generally, if our volume guidance is in between 10 to 20, you could expect another, 10% or close to that price increase advantage that the top line would get. So, anything, if we land in between 10 to 20, the top line could, the value top line could land in between 20 to 30. So that's the kind of guidance. But generally, that's not the volume guidance is the guidance we look forward to. That is the reason, because even the EBITDA will grow in line with the volume. So if the volume grows by 10%, the EBITDA will also grow by 10%. So that's the real, marker for the business that we look internally.
And that is the EBITDA per kg number, 110 rupees.
Yeah.
That's the...
Yeah, 105 to 110 rupees. Yeah.
Okay. And got that. Could you just very briefly break up the market segment for you now? How much is institutional, how much is going to, the branded, and just the overall breakup?
Yeah, so I think probably you're asking about the branded business now. So branded business, we did in India, the total India business last year, we closed at around 300 crores or so. And out of that, 200 crores was pure retail, which is our own brand. So that's the kind of, segmentation that we have got internally. Out of the branded business, we probably, end up doing 50% from the general trade, which is the Kirana stores, another 20% or odd from modern trade, and another 15 or odd percentage from e-commerce. So that's the kind of breakup we have for the domestic business. The brands are also doing really well. We probably are looking to drive a 40 to 50% growth this year, and from 200 crores, we are looking to close 25 at around 300 crores, maybe 10, 20 crores here or there.
And finally, just a last takeaway, as you grow this branded business, and I think the freeze-dried coffee plant is coming on stream, Vietnam, the expansion is on. When do we see CCL products go back to the 20s when it comes to EBITDA margin? Because I think last several quarters, the run rate's between 16% to 18%. You used to be in the 20s not too long ago. When do we see that happening?
So, okay, two things. First of all, actually 20 to 16 is not a reduction, because, you are looking at EBITDA percentage with respect to top line, and the top line is getting the price, because we work on a cost plus model. It's getting that price, while the top line is getting that price advantage, the EBITDA to the top line percentage looks, it's optically looking down, but it is not, because my per kilo EBITDA is not coming down. So now it's a very tricky thing. If the coffee prices were to come down, automatically you will see that the price, the EBITDA percentage to top line will go back to 20. So the better this thing marker to look at is
Would be
the
EBITDA per kg.
kilo.
Got
Yeah,
it.
and is something that we think that over a period of time will keep improving because we are focusing a lot on branded business, small packs, more premium and specialty coffee. So we are working
Got it,
on.
Praveen. We'll leave it there. Thank you very much for joining us and appreciate you being here on the program on CNBC TV 18 this morning. Good luck.